Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation. All right. Good morning. Welcome to the BOGART Effect. Today, I've got Sandra with me, and we're going to talk about the financial planning process at BOGART Wealth. So, Sandra, first time, welcome.
Yes, thank you.
And we've had some new additions to the studio, which is pretty exciting to see. But Sandra, tell me a little bit about your department at BOGART Wealth.
So I manage the financial planning department at BOGART Wealth. We are a team of about 5. So it's myself, and then I have 2 full-time planners, and then we have 3 of the AGT students that are in the department as well.
So just for anybody who doesn't know, AGT is our Advisor Growth Track program. It's an on-the-job training program that we do for really rising financial advisors that coming typically out of financial planning programs, and they have aspirations of becoming financial advisors themselves. And BOGART Wealth internally trains really this next generation of advisors.
Yes.
So, Sandra, the reason for this podcast is we have a lot of clients that say, why do you need all these documents?
Right.
Like, what is the goal? Like, it seems a little excessive.
Right.
Why don't we start with just kind of the list of what is it that's actually needed when we sit down for a consultation?
Sure. So what happens after a client has decided to engage in a financial plan with us, the next step is to collect all the data. And some examples of the documents that we need would include 401k statements, pension statements, stock options, restricted stock vesting schedules, bank statements. If you have outside brokerage accounts, statements, we'll need that as well. We also encourage if you can send us your tax returns so we can take a look at previous year's tax returns, pay stubs, any liability statements you have, mortgage, student loans, that sort of thing.
Well, and the way I frame it in a lot of instances, like the financial planning process really is to help be that guidance and steward for not only present day decisions, but future decisions as well. Mm-hmm. And maybe even taking a quick step back, like I think in our industry specifically, we talked about this a little bit earlier, but our job is to put ourselves in a position to anticipate what your problems are, right. Not only solve them, but also anticipate what they are in the future. And the reason that we spend so much time on planning is because that's the epicenter of a lot of this work that we need to do.
Yes.
It's as financial advisors, of course, getting the investments correct is important and giving good advice is important. But in order to do that, we really have to go through this planning engagement and really get into the nuances associated with every particular person's situation, because everyone's situation is different. Ages are different. Let's start there. Like, that's an easy one. Your spending needs are different, right? Your risk profile is different, right? Tax sensitivities are different. Like, so when we talk about creating that retirement vision, there really is no cookie cutter to any of this. And what we've done, and in my opinion, as we've built and scaled this department with you, is we've really been able to develop an enhanced level of subject matter expert work within the planning process. So as we engage with a household, whether they've become a client or before they become a client, we're able to already anticipate a lot of the questions that are going to come up because of the, let's just say, unique conformity associated with going after employees of one particular company versus another.
That's right.
And I think that that's extremely valuable in the context of we already know a lot of those questions and problems that we're going to need to be going after. And it formed into like why we're asking for particular documents along the way.
That's exactly right.
So let's talk a little bit about, we've now asked for the data. What's the next part of the process as we're engaging with a household?
So the next part of the process would be where, you'd meet with your advisor. They would go over our financial planning questionnaire just to get some additional data, like soft data, if you will, from the clients. And that's like Asking them what's their retirement goals. Do they have a specific goal set in mind? Do they want to look at different retirement dates? Do they have children that they want to look at some college planning for that we need to prepare for? Sometimes there may be one-off major expenses in the horizon. They want to plan for a wedding, a big trip. This is the opportunity for, like I said, the advisor to really get a good sense of what the goals are, what the client's looking to do, and then we incorporate that as we build the plan as well.
And just to pull on a couple of threads there, like you mentioned goals, like that's the epicenter because what we're trying to do is anticipate / solve for your problems, right? So the common ones, as you already listed, are big expenses. Maybe it's a new home or relocating. What's the tax difference, as an example, between retiring in Texas versus Virginia, as an example, right? And going through some of those hypothetical and what if scenarios, I think is a really important part of this process. So after we've done the data request, we've done this initial consult, then the follow-up meeting is we're actually presenting a plan.
That's right.
What does that look like?
So when you present the plan, now one thing I do want to step back, as we're building the plan and we're building, like I said, we talk about your goals. We're also looking at, running different scenarios. If we want to run different scenarios, if we want to run some stress testing to the plan, we look at that as well. And so once we have all that completed, then the advisor will present the plan. They go through the documents. And really, I would say the software that we use is primarily like cash flow analysis. It's cash flow based. So that's the reports that the client will see is going to look at, all the detail that we put into the plan, all the base facts. Then they're going to look at, all the inflows and outflows, and then kind of the cash flow report kind of shows everything put all together. So they can see, year by year what their projected inflows and outflows are projected to be. And then you could do that all the way through the end of the plan, and you can see what their projected ending portfolio value.
Let's get a little more granular. When we say inflows, like that is talking about Social Security income. That's talking about vesting of restricted stock.
That's right.
Any part-time consulting income, but it's not talking about dividend income or cash flows. That's all part of the rate of return assumption, right? So, and then what I love doing is when we break down the outflows, which is outflows is expenses, right? What are we spending money on? The way that we've designed the cash flow modeling on the expense side is we can get extremely specific in some instances, like 15 pages of expenses, but we also can get just very high level. The reason that I think a lot of instances it makes sense to start bifurcating or breaking them down is because we can do more of the hypothetical what if stress testing that you're talking about. And just to give an example, so if someone has a mortgage, the principal and interest portion of that mortgage is not changing in the accumulation of their plan. So we don't need to inflate that at whatever our inflation assumption is. We also have a lot of clients, we call it the go-go phase, which is usually the period right after they retire where they're very active, very healthy, traveling, spending money, and it's typically a higher spend period. And then it starts to move to what we call the slow go and then inevitably the no go. And so what we're doing there on the expense side, which again, just high level on the outflows, is we're modeling expense scenarios where you might have that period of time where we want to do a larger budget for the fun stuff. And then we start to wane that down as an example. It's similar with like gifting strategies to kids, or to charities, right? We've seen all of that where the beautiful part of modeling the outflows is we can get as specific and granular as you want, or we can keep it very, very high level and macro. Sandra, let's talk about the base assumptions that we do within our plans. And maybe anecdotally, let's talk a little bit about why we do them as base assumptions.
So one of the base assumptions that we assume is a 5.5% rate of return on the investments. And we've chosen that to be more on the moderate side. Now we know over the past 100 years or so, we know that stocks have outperformed. You can get about anywhere from 8 to 10% a year on your investments. We choose to be a little bit more moderate because when we're building plans, we prefer to be on the more conservative side of building the plan, but we also don't want your plan to be dependent on achieving such high returns every single year. So that's why we've chose a more moderate 5.5%.
Well, and so I will tell you, empirically, 5.5 is very conservative. But most importantly, I'm going to emphasize we're using a 2.5% rate of inflation assumption. And so really what the plan is built off is what we call a real rate of return,
right,
which is the difference between the rate of return assumption and the inflation assumption. So the plan really is being built on a 3% real rate of return.
That's right.
Which no matter what empirical evidence you use, that is a conservative assumption, even for a conservative investor. What we have found, and what I will say is planning is not a one-time exercise. It is an organic exercise that has to be revisited year over year, and honestly, sometimes intra-year if situational guidance is changing. For example, a relocation, a death in the family, something that is causing a material financial impact on your plan. And it's important because we use it, again, as the guidance point for future decisions that we're making. But also, coming back to this rate of return assumption, it's so important because we're going to have years that the markets go down.
That's
that is guaranteed. That's the only guarantee I'll ever give somebody is that we're going to have years we lose money.
Right.
We're also going to have fantastic years. Like 2024 has been a fantastic year. 2023 was a fantastic year. 2022, not so great. But the point is when you smooth all of that out, you're going to have years where you exceed the expectations. You're going to have years that you underperform. And that's partly why you have to constantly be recessing the base. Anything else with regards to assumptions?
Well, with assumptions, we do longevity in the plan to age 90 is what we assume. We assume that, excess spending. If you have year-end cash flows that that you have extra cash every single year, we assume that is just being spent while you're working, and then at retirement, we assume that we're saving that in as well. So,
which that's a great example of both of those, where depending upon the situation, like I've had clients that said, "No, my mom and dad lived well into their late 90s.
Yeah,
we'll run later in that scenario because we're using empirical evidence to enhance the longevity assumption." But we've also had ones where both my parents died in their mid 70s, and 90s probably pushing it for me because that's just not in my DNA nor my health and wellness goals, right? So we have all of that, and we have the latitude to be able to do it. Let's talk a little bit about the analysis itself, maybe in a little bit more detail. So, obviously we talked a little bit about the retirement analysis, and we talked about the cash flow based reporting that we do, but that's not the only thing that we're doing when we engage with a household.
Absolutely not. That is just one part of the planning that we do. We also run the NUA analysis, and as James mentioned, we are subject matter expertise with this. So when we request a savings plan statement, for example, we're wanting more than just the balance on that savings plan. We want the detail so that we can run the NUA analysis.
So real quick, I want to pull on that because what is NUA? So NUA is net unrealized appreciation.
Right.
It's a tax strategy for any individual that works at a company and they have their employer stock in their 401k plan. Again, it's just one part of a bigger conversation. But in order for us to be able to really demonstrate the value that NUA might provide for a household, this is a great example where when we come back to like the document request, as you're alluding to, right? It's like a lot of clients, they'll just give us, hey, my 401k balance is worth this much. I'm like, okay, that's great. But in order for me to actually do what we believe will be the most value added for you, we need the whole statement, which includes the transactional history of every single share that's acquired. Now, some companies' plans have an itemization.
Right.
Some companies' plans just keep an average balance. Regardless, it's impactful to be able to look at that. Now, by the way, that's one anecdotal example of why we would want the whole statement. Some employees, they have Roth in their 401k. Some employees have after-tax money in their 401k that's eligible for things like a mega backdoor Roth. These are all examples of why we would need all the data.
Exactly. Right? And if that's something we need to model in the plan, either the NUA or the mega backdoor Roth, that's something that we would model also in your plan.
Comes back to that theme of like we're trying to solve problems and anticipate what future ones will be.
Exactly.
And talking about that. Now, within the planning guidance, like again, every situation is a little different. Education is one, right? So some of our clients are either trying to solve for funding their own children's education. Some of them are trying to fund for their grandchildren's education.
That's right.
What does that look like?
So when we run the education analysis, we need to get the more data we can get from you, the better. But what we're really looking for is, are you interested in private or are you interested in public college? Are you looking for in-state, out-of-state? And what's nice with our software is we can run those different scenarios. We can get an idea, okay, are you currently contributing to a 529 plan? What are you contributing? What do you have? We can take that information and then we can run the analysis to say, well, if you want to go to private, this is how much more you're going to need to put into your 529 plan. If you want to go to state or public in-state, this is how much you're going to need. It'll show us what the any shortcomings there are, or if the funding goals are met.
Well, and I'm going to tie it personally at this point, right? It's like there is a material difference now between in-state, public, and private. Like, I just so happened, I went to UVA and I was looking at the tuition rates for UVA actually over the weekend. And, all in, including room board, they're saying 30, 35,000 roughly. Whereas just out of state, UVA is 57 for tuition alone. That number was boggling me. Yeah. And then I looked at Vanderbilt was the first college to break $100,000.
Wow.
So, the reality of, and now, by the way, that we could spend a whole session talking about education funding, but I do think that we need to have a serious conversation around what is the desired level of savings.
Right.
And part of it's modeling. And what we haven't talked about yet is the laws keep changing. Like the rules keep changing, right? So I'll use anecdotally, I don't want to take too much time on this, but like this is one where 529s now, you can use $10,000 for education expenses before college.
Yes, that's right.
So dependent upon how mom and dad or grandpa and grandma are trying to cover the costs of these things, they might say, no, I want my grandkids to go to private elementary or high school. Right. Okay, well, that's another funding assumption as to why the planning software is so impactful, because now it's like, well, it's not just the college, it's also the college plus.
That's right.
And then even last 2022, the Secure Act 2.0 came out and said that if there's $35,000 left in a 529, you can use that for a Roth. So now there's another planning example. Point is that we use the software to help us make some educated decisions about things that are happening in the future.
That's right.
And really use it as the guidance point. Now, another one that we talk a lot about is Social Security.
That's right.
And talk to me a little bit about what that output looks like.
So with that output, so what we would need, obviously your Social Security statements, right? We would need an updated Social Security statement, and we run it through another software that we use. And what it does is it kind of helps us determine what is the best timing for you to take Social Security. It helps develop, or the output is, what is the best time? What is the best strategy to take? We can put in different strategies, different timing. And from there, it kind of just helps us along the lines of what we should put in the plan, what, any discussions you want to have, it's just Social Security timing. When's the best time to take it? Yeah.
Well, and pull on a couple things you just said there. There's over 77,000 timing strategies for Social Security for a married household. So it's a lot of data that needs to be processed. But I think the most important comment you just made, and I want to emphasize this for the audience, is it's the integration of that respective planning component back into the plan that really is the value. And like, for example, we've talked about our cash flow reporting that we use for kind of the baseline retirement assumptions. We talked about the NUA reporting, talked about Social Security, talked about education. Each of those, independent of the others, is just a piece of the overall. Like the value truly is the integration as we're pulling all of these different pieces together as we present this guidance. And it's done with a deliberate purpose of answering these questions, solving these problems, and most importantly, helping anticipate what future ones are going to be.
Exactly.
Let's talk about tax, right? So to me, the tax piece of what we do at Bogart Wealth is probably arguably one of the things that makes us most unique, because there's not a lot of CPAs out there that are giving proactive tax guidance. And candidly, not a lot of financial advisors are either. Talk to me a little bit about how we model some of those hypotheticals. What does it look like as we build out tax optimization work?
So one of the big ones that we work on a lot is Roth conversions. We model a lot of Roth conversions for our clients, and in discussion with the advisor, and the client, we get an idea of what their current tax bracket is, their marginal tax bracket, what we want to maybe bump up to, and we model scenarios based on that. One thing that's also nice that the software takes into account is the sunset laws that are expected to expire. So we can really do some good in-depth analysis, trying to keep you within a certain tax bracket and just see the impact that doing Roth conversions has on your overall plan. What's the tax savings there? What is the ending portfolio value of those tax-free assets is also very big, and how you're going to pass that on to future generations.
So I want to take
heirs.
a quick step back just for anybody who's not familiar with what a Roth conversion is, right? So, and you're absolutely right. We're in the fortunate position where we're a lot of retirees, and a lot of our retirees have accumulated most of their savings in 401ks, or they have a pension or a pension lump sum option. So it creates big pre-tax accounts.
Right.
And so what that means is these accounts, they hadn't had any taxes associated with them on the way in. They're growing completely tax deferred. And when the money comes out, you pay ordinary income. Blessing, right? Because you've had all this tax deferred growth. However, when you go to pull it out, the ordinary income piece can be highly detrimental in certain instances, specifically for households when they hit the age of required minimum distribution. So, and that number is age 73 for anybody who's born 1959 or sooner. If you're 1960 or later, that RMD age is age 75. By the way, most Americans, this is not a conversation of a problem.
Right.
It just so happens that the households that we tend to work with, this is one that we need to actually have this discussion around. And why it carries significance, as Sandra just said, is if we're building this plan out and we're modeling that your required minimum distributions are going to be larger than what it is that you are spending, well, that becomes a tax conversation. And frankly, this is when I think about solving problems, like that's a problem that it's a great problem. I call it a bougie problem. I'd rather have the assets I have to pay tax on than not have those assets.
Right.
But the point is if it's something that we can add value by modeling this and model the implications of this. And oh, by the way, the performance over the last couple of years of these assets has really predicated the value of this type of strategy work. So like, for example, in 2022, when the markets were down, we were as aggressively as we could repositioning those assets. Now, it's not that we would ever know when the markets are going to go down or go back up, but we do have conviction that over the long term, the markets will go up. And part of the conversation around helping with stewarding assets and guidance is getting them positioned in the right places when they're growing. Right. So
that's right.
And part of this conversation around Roth conversions, right? Like you can tell I really like Roth conversions. And the reason is Roths grow completely tax-free.
That's right.
As long as you're over the age of 59 and a half and that Roths existed for over 5 years, all of the growth is completely tax-free, but also no required minimum distributions.
That's right.
So it's obviously I like Roths a lot. However, in order to get the money in there, you got to pay tax to get it in there. So there becomes an economic conversation. And so I'll use an example as we're doing this modeling. If we're building someone's plan and we're anticipating their future effective tax rate is, let's just say 28%. That's a big RMD, right? Like that's actually really pulling their ordinary income up. But let's say today they're at 15% or a 17% effective tax rate. Well, I'm not going to say it's a no-brainer, but that is a very compelling reason to have this conversation of, yes, let's go ahead and convert some of the pre-tax over to a Roth so that all of the growth from that point forward is now an environment that's not subject to required minimum distributions and is completely tax-free.
Right.
There's another part of this conversation around legacy planning. We do a lot of next generation legacy planning, especially if that's a goal that a lot of people have. But if we're in a situation with a household where they're planning on leaving money or there is going to be money left behind, they might not necessarily be planning for it, but there's money left behind. If the money is in an IRA, they have to take it all out over 10 years. And that's ordinary income.
That's right.
If it's in a Roth, they still have to take it out over 10 years. But it's completely tax-free. So, there's another 10-year tail on this planning work for this legacy conversation as well. Talk to me too about charitable giving. We have a lot of clients, very philanthropic, that ultimately this is something that has to be indoctrinated in the planning.
Yes, absolutely. And that's, if it's something that's one of the reasons also why we like to look at your tax returns to kind of see the history of your charitable giving. And we like to model that into the planning as well for you. And we also look at opportunities for QCDs. If there's
what is that?
A qualified charitable distribution. Sorry about that.
No. We're all guilty of this.
I'm a planner. I know.
We use the acronyms, but sorry, I interrupted you. But a qualified charitable distribution.
That's right.
At age 70 and a half, you can actually take up to $105,000.
I believe so.
From each husband and wife to go directly to a charity.
Right.
but that can also offset those required minimum distributions.
Exactly.
So for example, if you have to take out $200,000 for an RMD for a required minimum distribution, you then can, let's just say you give away $100,000. Well, now the only taxable portion is $100,000 that's
right.
left behind.
That's right.
Which again, depending on how philanthropic someone is, that's a strategy to help with
exactly.
this. Now, the interesting thing about qualified charitable distributions is it's age 70 and a half, right? So that's actually let's just say antiquated age,
right.
Because the required minimum distribution age used to be 70 and a half.
That's right.
But they never indexed up the QCD age. So there is an opportunity for anybody who wants to distribute directly to a charity from an IRA. Now, you don't get a deduction for that. Like that's the negative to it.
Right.
But it does reduce the pre-tax balance.
That's right.
And all the growth is then, obviously not there. Anything else tax-wise? I know we kind of danced around this a little bit.
I think those are some of the big modeling strategies that we do in the plan.
And I think part of our planning process too is we do integrate a lot of this legacy estate planning conversation and anecdotally also insurance conversation associated with it. I think at a macro level, right? Like if we're in a position where we're not leaving behind a tremendous amount of wealth, then that does simplify some of this.
Yes.
But if we're also in a position where we're leaving a number that's larger than what it is today, then now there's another level of conversation that has to happen. That's a great example of the organic nature of this conversation around planning and why it needs to be the epicenter.
Right.
But that's also a great segue to talk about some of the hypothetical and alternative modeling that we do, right? So, when we go down the road of legacy planning, obviously some people might say, and the reason this carries significance, by the way, is if we get to a point where we're over an estate tax threshold, there's another level of planning that needs to be done. And for 2024, it's $13.71 million each, so roughly $27.44 million. If you're under that threshold, we don't need to talk about, which I will admit is a large percentage of our customer base. But if you get over it, then there is an advanced level of planning that needs to be done.
That's right.
And then for next year, it's going to $13.99 million, so just under 28. But the point is that if we're under those thresholds, we don't care. Now, by the way, you mentioned it earlier, but there is currently a sunset that's going to happen of estate tax laws. So that 13.99 under current law is going to go down to 5 million indexed up. So that's an example of the, again, organic nature of this planning.
That's right.
Where the target's moving. Now, admittedly, with the outcome of the elections, ultimately, I anticipate that we're going to see those thresholds changing. But the reality of it is we don't know. We're going to operate under fact right now. And that's the fact is that under current law, estate tax thresholds are going to go back down. I anticipate we'll probably see something early 2025 on guidance of what it's going to be, but we don't know. So that's an example of a hypothetical that needs to be modeled though.
Right.
What are some of the other hypotheticals that come up along the planning process?
So what we've seen is, like I mentioned earlier, very different retirement ages. People, maybe they want to just get out of their current environment and they say, look, I might work part-time somewhere else, but I need to leave this particular employer. And so we run different scenarios with that, maybe part-time work, different retirement dates. We also look at like some of the stress testing that we look at is we will run like a premature death. We'll look at your plan, we'll put all those base facts, but then we'll look at what happens if there's if one of this, husband or wife has a premature death? What kind of impact does that have on the plan?
And really, it's done with the vein of trying to break the plan.
Exactly.
Like what do we need to do? Like, what are the things that we're not anticipating?
That's exactly
that can materially change the outcome of this household, right?
That's right.
And I think it's important to do that. Anecdotally, we talked about this yesterday as we were preparing for this, but it's like you want to plan to an extent, but you don't want to go like too, let's just say doom and gloom, where you get too conservative as well, right? So it's just kind of finding that happy medium.
Yes.
But like, I'll use an example, right? Let's say husband's side, no one has lived over the age of 75, right? Like that's just a pretty good precursor of genetic disposition. Now, of course, hopefully they're healthier, right? But on the wife's side, someone, their family history is well into the 90s. Yeah. Well, that's an example of if we plan both of them living to age 90 and unfortunately something happens to one of the two of them, the tax rates change.
Yes.
And that can happen. By the way, it's an example. We talk about these large IRA accounts and pre-tax assets. the required minimum distribution number does not change whether you're married filing jointly versus single or head of household, right? So the RMD number is an absolute, but the tax brackets are materially higher, right?
Yeah.
So that can create a bleed on the portfolio itself.
That's right.
So I don't want to go too much longer,
Sure.
right? But we really did cover what the process looks like. And I think just to kind of summarize it, what we're trying to do here is not only solve for current problems, but anticipate what the future problems are.
That's right.
And planning, in our opinion, is the lifeblood of a lot of those conversations.
That's right. Everything comes back to the plan.
Absolutely. And frankly, I think when we talk about Bogart Wealth and what makes our planning process unique, it's the subject matter expert work. Hopefully that demonstrated in some of what we talked about today. I mean, we know some of these tax laws better than arguably most of the HR people at the companies that we're working with. But I would also say we're trying to find ways of adding value along the way and solving these problems.
That's right.
Sandra, it was awesome.
Thanks
for the time today.
Thank you so much. I really enjoyed it.
The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.